Right now, a 300 credit rotation is forming, and investors don't know about this credit that's forming. Wall Street traders don't see this coming, and people like us don't see this coming. Maybe we're completely missing the whole big story, and it's completely different house. Everybody's realizing it. These companies, they're not just gambling, they're building actual products, straw by straw, out of a broken credit market. Alright, so here's something that nobody's talking about and nobody's seeing. They're putting compensation funds out there and nobody sees it. Now, since 2009, pensions fund has performed into bonds since 2009. The Termination bond alone has rise to $1 trillion, and it got a lot of dollars in funds right now. And it's mandated by law. Property casualty insurance hold too much money in bonds right now. Well, cause tax advantages, things like that, things of that nature. Here's the real kicker. So, global debt has hit a rise. It has hit a rise of $3 trillion. That's global debt and federal debt. Corporate bonds combined. The entire Bitcoin market is only 2 million. We're talking about it has been trapped in debt. Here's what's killing these investors. The into money sign that I never talked about, gone to 2 trillion million and 2 point what? But it has 46% today. Now do the math. That's roughly a 10%. So you got millions of retirees people had been retiring every single year. And the lower the fundings get, the more bonds that they hold. It's a death spiral with a moratorium mandate. And the investors wanna outweigh, they're looking for an outweigh. But the mandates keep them locked in place. If there was an actual mandate to meet these bonds, well, here's the deal. Traditional credit markets, they're not just underperformance. In 2008, there was a crash. Now, these were supposed to be safe investments. So nobody can easily predict the risk was. 50% the rating agencies had no clue, but they're rating that same bundle. Commercial lending is 16 per trillion of growing. Sovereign debt has 12.3 trillion in debt also as well. and that they make them possible investors to invest into that. Here's what's crushing everyone. But debt servicing costs went to the lowest to the highest in 2 years. Investors, they keep bidding bond prices higher. Why? Because they're mandated to buy these stuff. So you got desperate buyers that's complying. Everyone's racing to the bottom for lower and lower returns and higher. There's total ups, government, corporate bonds globally over 100 trillion. It's larger than global GDP. The CDO market peaked at 2 million. Today's credit market 50 times larger. Also, the system is drowning in complexity. And $1 trillion are trapped into instruments nobody understands. They don't compensate for the actual risk. What if there was a completely different approach? What if bundling? Now here's what Wall Street doesn't want you to know. Now BlackRock charges 0.45 to and 0.02 their bonds, and that's just a percentage. That's less than half an 8% bondage per year. Corporate bond underwriting, it's way thinner. It has a 15-year death spiral. It got so bad that Citi and couldn't support their bondage. It's on 50 million opportunities for rivers, and that's crazy. Get to a point there, spreads are so low. It's margin on the deal, but that became so low. But there's a deal. We're desperate, trying to stay profitable, trying to get a deal. And it's lower cost and better technology. But they're still just fighting over breadcrumbs. In your margin, then you can't innovate. Heavy margins, higher fees. So let's recap here. Wall Street percentage, I would say low. It's low right now. And your manual fees are under 1%. Okay, now that's a problem. Now imagine like you can keep instruments that produce more money.